As you saw, North American markets in the green today. My next guest suggests that we may see a rally in Canadian bonds if concerns about a broader market sell-off continue. Let's go to Royce Mendes, Managing Director, Head of Macro Strategy at Desjardins. Thanks for joining us today.
My pleasure.
So it's been a volatile time in which we're seeing some, for example, big tech get hit, but not others. What's the rationale you're seeing play out?
Well, I think there are just generally fears about froth in the market. And so you're seeing some of this materialize into a sell-off, into volatility. There's also questions about the future path of the Federal Reserve. There's questions about the future of inflation within tariffs. So I think there's a lot of concerns out there, and it's resulting just generally in this market volatility we're seeing right now.
All right. Do you see this rotation out as positive?
Yeah, I mean, what you're seeing right now is during times of high volatility, we're seeing inflows into Canadian government bond funds. You're seeing some of the tail risks in these Canadian government bonds receding, and what that translates to is clearly a safe haven bid for Government of Canada bonds, which is really interesting in a time where the Canadian economy is at threat from the trade challenges from the U.S. You're seeing global investors view Canada, and specifically Government of Canada bonds, as this safe haven asset that they are flowing into during times of high worry and high concern. This is going to help finance the deficit that we're planning to run here in Canada, both at the federal and provincial levels, with more investor demand. It's also going to create an environment of opportunity in 2026 for that money to be put to work into very productive uses. So right now, it's a really interesting time in Canada. While other markets are seeing outflows, Government of Canada bonds are seeing inflows. And actually, it's not only Government of Canada bonds, it's a bunch of Canadian assets that are seeing inflows as global investors rotate a little bit away from the U.S. and towards other jurisdictions that they see as safe and consistently stable.
You say global investors. Any indication of where the money's coming from?
Well, we know that places like China, places like India, these formerly huge participants in the U.S. Treasury market have pulled back. Not necessarily that they're selling in huge amounts, but the margin and dollar of capital they're not putting to work in the U.S. Treasury market. And some of that is spilling over into the Canadian bond market. We're also seeing global central banks that want to park money in a very safe place, look at the Government of Canada, see its AAA rating, and think to themselves, hey, I think that's a pretty good place to rotate a little bit of money into. It's a wide swath of investors, all the way from hedge funds to, as I said, central banks and everything in between, that seems to be taking a much closer look at what is going on here in Canada, despite the challenges we face right now with the economy and with trade.
I was going to say, you say Canadians aren't as affected by the market volatility. How so?
Well, if you just look at the household balance sheets in Canada, what they're heavily exposed to is obviously housing. That's not a new story. Everyone knows that. But you compare that to the U.S., where American households are very highly exposed to stocks. They have a lot of their assets in stocks. And so when the market is rising, it's great news. Look, they're feeling wealthier. They're out there spending. But you go through a few months like we've just seen, and potentially a few months in the future where there's further drawdown, and you could start to see American households pulling back because they're feeling poorer, whereas in Canada, households are not anywhere near as exposed to equities. So this market volatility is not going to shape the future of the Canadian economy the same way it could shape the future of the U.S. economy. Obviously, there are things that are challenges and headwinds here, but the stock market volatility is not high on that list of challenges.
Okay. Also today, U.S. consumer confidence numbers came out. That number is down. Does this signal to you wider concerns?
Look, I mean, it's not great when you see consumer confidence numbers like that, but we have seen a divorce in these surveys between, what they're saying, people are saying, how they're feeling, and then what the economy actually does. So I don't want to put too much stock in that. But generally speaking, there was a whole host of numbers released today. Retail sales, PPI, they all look pretty soft. And I think you can come to a conclusion, a reasonable conclusion, that, the Fed probably should lower interest rates a little bit more. Now, will that help the the stock market? Maybe a little bit. But if the Fed also signals that after they cut this one more time, potentially, that they're on hold, that actually may lead to the opposite. It may lead to a further sell-off, with the market pricing significantly more cuts and then having to pull back if the Fed says, okay, after December, we're all done.
Okay, expand your outlook a little bit more for me, because what we're seeing, companies like Best Buy, which did very well in its latest quarter and has raised its guidance because they think Black Friday and also end of year holiday sales are they're going to do well for that. But then we see consumer confidence sort of pulling back. So how would you describe the current state of the economy? And I'm talking more generally North America.
Yeah, I mean, I think we're in a fog right now, right? I mean, we are hearing from businesses, but we haven't had a lot of hard economic data in a while out of the U.S. What we're seeing in Canada is sort of middling growth, conflicting signals on growth and inflation. I don't think there's anything clear about the path forward for either the Canadian or the U.S. economy. I think 2026, there are a bunch of challenges that Canada is going to face, not only with regards to the stagnation in the economy currently, but also with regards to the USMCA renewal. In the U.S., there's big questions. I mean, this momentum is clearly slowing. And what comes in 2026, when maybe the effects of all these tariffs start to show up in the inflation numbers, what happens to consumer confidence then? What happens to household spending then? I think there are some really big questions ahead of us. And without data in the past few weeks in the U.S., only getting a trickle right now, we're really in the dark about where we even stand right now.
Yeah, so that won't come, we know, as you said, till mid-December. Royce Mendes, got to leave it there. So thanks for your time. Royce is Managing Director, Head of Macro Strategy at Desjardins.